Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories within company filings and give it to you straight. If you like straight talk about big business, then you are in the right place because today we are diving deep into ACCURAY Incorporated file, with the SEC to shed some light on their financial health and what could be hiding beneath the surface. So ACCURAY Incorporated, this is a company that designs and sells special machines for treating tumors with radiation therapy. Think complex medical equipment that requires a lot of science and precise engineering. They filed a Form 10Q-TEDR, which is basically an amended report to correct some previously issued financial information. This happens sometimes, and these corrections can reveal a lot about how a company manages its finances and disclosures. The big reason for this filing is that ACCURAY found some errors in how they reported something called remaining performance obligations, or RPO. Now, RPO sounds complicated, but it essentially represents future revenue that a company expects to earn from contracts that are already signed but not yet fully delivered or completed. Think of it as a company's promise of future sales. They discovered that they incorrectly included certain orders in their RPO disclosure. Basically, they thought some open system orders and upgrade sales orders represented RPO, but after re-evaluating it, they concluded that these particular orders did not have enough customer deposit or commitment to be considered a firm RPO according to accounting rules. This might sound like a small detail, but it led to a massive reduction in their reported RPO balance from $866 million down to just $59.3 million. Importantly, the company states these errors did not affect their main financial statements, like their balance sheets or income statements, only the footnote disclosures. This is a crucial point to remember. Now, this restatement is a big deal as it points to potential issues in their internal controls and how they review their financial data. The company itself stated that the previously issued financial information should no longer be relied upon due to these errors. This is a serious statement from a public company. Let us jump into the financials starting with their balance sheet. As of the 30th of September 2025, their total assets were around $457 million, a slight decrease from the 30th of June where it was about $470 million. Looking at their liabilities and equity, you see a similar trend. Total liabilities went up slightly to about $395 million from around $389 million at the end of June. This means their equity, their net worth also decreased from about $81 million to $62 million. Not ideal, but not a red flag on its own yet. One line item to note here is accounts receivable. It dropped significantly from $83 million in June to about $54 million in September. This could mean they collected a good chunk of what customers owed them, or perhaps they sold less. The allowance for credit losses also changed from $369,000 to over $1 million. This is the amount they set aside for customers who might not pay. That increase is something to keep an eye on. Their inventories, however, went up from $141 million to $156 million. This means they are holding more goods. For a company that manufactures complex equipment, this can sometimes mean they are building up stock in anticipation of future sales, or perhaps production is outpacing sales. Now let us look at how they performed in the 3 months ending the 30th of September 2025 compared to the same period in 2024. Total net revenue decreased from $101.5 million in 2024 to about $94 million in 2025. That is a drop of about 7.5%. Their cost of revenue stayed pretty steady at around $67 million in both periods. But because their sales decreased, their gross profit took a hit. Gross profit fell from $34.5 million in 2024 to $26.5 million in 2025. This is a drop of nearly 23%. This means they are making significantly less profit on each dollar of sales. This lower gross profit directly impacted their operating income. They went from a small operating loss of about $2.1 million in 2024 to a much larger operating loss of over $11 million in 2025. This is a substantial increase in operational losses, and their net loss widened considerably. In the 3 months ending September 2025, they reported a net loss of over $21 million, meaning a loss of 18 cents per share. This is a big jump from a net loss of about $4 million or 4 cents per share in the same period last year. This is a clear sign their profitability is worsening. An interesting number here is the weighted average shares outstanding. It increased from about 100 million shares to almost 119 million shares. This increase in shares means that even if their net loss stayed the same, the loss per share would be worse because the loss is spread over more shares. This is a dilution effect for existing shareholders. This comes from the issuance of new shares, for example, related to their warrant agreements. Remember that RPO correction we discussed earlier? Here is where it matters. The report shows that the total remaining performance obligations as of the 30th of September 2025 is now $59.3 million. This is after excluding over $800 million worth of orders that they concluded did not meet the accounting definition of RPO. This massive adjustment shows the importance of careful accounting and disclosure review. ACCURAY also uses derivative financial instruments, mainly foreign currency forward contracts. These are used to manage risks associated with fluctuations in currency exchange rates. As of the 30th of September 2025, they had about $60 million in these contracts designated as cash flow hedges. They also had about $51 million in balance sheet hedges. These instruments are meant to protect against financial losses from currency swings, but they also come with their own complexities and risks. Debt is a significant factor for ACCURAY. As of the 30th of September 2025, they had about $140 million in net debt. This includes a $150 million term loan and $18 million in convertible senior notes. The weighted average effective interest rate on their term loan is quite high at almost 24%. This indicates they are paying a lot for their debt financing, and a major development was their new 5-year senior secured credit agreement entered into in June 2025. This $150 million term loan facility, along with a delayed draw facility and a revolving credit facility, brings their total available credit to $190 million. But it comes with strict covenants and security interests on substantially all their assets. This means if they fail to meet these covenants, their lenders could potentially take over their assets. They also have these convertible senior notes due in 2026. In May 2025, they exchanged about $82 million of these notes. This means the remaining amount is about $18 million. Convertible notes can be a double-edged sword. They can provide capital, but if converted, they can dilute existing shareholders. ACCURAY operates in a single segment, the Oncology Systems Group. All their business revolves around developing, manufacturing, and selling radiation therapy systems. The company believes it is best to report revenues by geographic region. Their revenues are broken down by Americas, EMEA, China, Japan, and Asia Pacific. In the 3 months ending September 2025, total revenue was about $94 million. The Americas saw a decent increase from the prior year, while EMEA also showed growth. However, China experienced a significant drop in revenue from $34 million to $15 million. This is a major shift and something worth investigating further, perhaps due to trade tensions or market-specific issues. ACCURAY has a 49% ownership in a joint venture in China called CNNC ACCURAY Tianjin Medical Technology Company. Limited, this JV manufactures and sells radiation oncology systems within China. Their investment in this JV is about $4 million. The JV is performing okay with revenues of about $20 million in the 2025 quarter, a slight decrease from 2024. Their income tax provision is relatively small at around $471,000 for the 3 months ending September 2025. They are maintaining a valuation allowance against their US deferred tax assets, which means they do not expect to utilize those past losses for tax benefits at this time. This section is crucial. Due to the restatement of RPO and the resulting errors, the company has concluded that their disclosure controls and procedures were not effective as of the 30th of September 2025. They found 2 material weaknesses in their internal control over financial reporting. First, a weakness in reviewing footnote schedules supporting financial statement disclosures, and second, inadequate controls to analyze all relevant information for complete and accurate GAAP presentation. They are implementing remediation steps, but until these controls are proven effective, investors should be cautious. Now for the risks. ACCURAY faces a lot of them. They mention global economic conditions, tariffs, inflation, recession, credit market instability, and geopolitical concerns like the conflicts in the Middle East and Ukraine. They also point to supply chain constraints and rising material costs as significant headwinds expected to continue through at least fiscal year 2026. Their high debt levels and past non-compliance with financial covenants are also highlighted as a major risk. The fact that they have identified material weaknesses in their internal controls is a significant risk itself. If they fail to fix these issues, it could impact their ability to produce timely and accurate financial results and could erode investor confidence. This is a serious concern that investors should not overlook. Looking at the company as a whole, I see a company with innovative technology in a growing market, but facing significant financial and operational challenges. The revenue decline, the widening losses, and the material weaknesses in internal controls are serious red flags. While their products address a critical medical need, the financial performance and the need for this amended filing suggests that they are struggling to translate that into consistent profitability. The high debt and the interest rates associated with it are a major burden. The geopolitical and economic risks they highlight are very real and are impacting their sales, especially in China. My assessment is that ACCURAY Incorporated is in a turnaround situation. They have a viable product but need to significantly improve their operational efficiency and bolster their internal financial controls. The leadership changes mentioned in the report also suggest a company actively trying to steer itself in a new direction. Investors need to watch closely how their remediation efforts for internal controls progress, and if they can stem the tide of increasing operational losses and stabilize their revenue. The high price of their products and the long sales cycles mean they are very sensitive to economic downturns and customer financing availability. So what is my take on ACCURAY's future? It is a high-risk, high-reward situation. If they can successfully navigate these challenges, especially improving their internal controls and controlling costs, their technology could offer significant future growth. However, the path forward is uncertain and filled with significant risks that could lead to further financial distress. Hey everyone, thanks for watching this deep dive into ACCURAY Incorporated's latest filing. What do you think about their situation and the restatement? Let me know your thoughts in the comments below. If you found this analysis valuable, please hit that like button and subscribe for more corporate decoder content. Also join our community on Discord linked in the description for more in-depth discussions. We will see you in the next video.